Hello guys, this is episode number 15, and in this episode, we're gonna delve deeper into a brief introduction to the Wyckoff method. So we're gonna discuss about the history of the Wyckoff method, the and its development, evolution, and of course, the modern adaptations. Okay, so let's get started. Okay, so the Wyckoff method is a technical analysis approach to trading stocks. So remember that Wyckoff method is a technical analysis approach, okay, to trading stocks. Okay, and I'm gonna just add more as well. Okay, so the Wyckoff method is a technical analysis approach to trading stocks, forex, CFDs, futures, etc., developed by the Richard D. Wyckoff in the early 20th century. Here is the breakdown of its history, development, and evolution, and of course, the modern adaptation. So first, we're gonna explore about the history of the Wyckoff. Okay, history. Okay, so Richard D. Wyckoff was a trader, educator, and author who started his career as a stockbroker at the age of 15. Over the years, he observed the market closely and analyzed the activities of large institutions and experienced traders. So Richard E. Wyckoff started his career as a stockbroker at the age of 15, and over the years, he observed the market very, very closely, and he also analyzed the activities of the large institutions and banks, such as banks and investment banks, hedge funds, etc., even the brokerage houses, and he also analyzed the activities of experienced traders. Okay, and after analyzing the activities of both large institutions and experienced traders, then so whatever observations he made, so based on his observations, he developed a methodology for understanding the market dynamics and identifying the potential trading opportunities. This methodology eventually became known as the Wyckoff method. All right. So it's very simple to understand, right? So now we're gonna see the development of the Wyckoff method. Okay, development. The Wyckoff method is based on the principle of supply and demand. Okay, and the interplay between them in the financial markets. Okay, so the basic foundation of Wyckoff method is laid upon the principles of supply and demand and how the supply and demand dynamics interplay, okay, between each other within the financial markets landscape. Okay. He believed that by studying the price and volume movements, one could gain insights into the intentions of large operators, or we can say that institutional investors, and make informed trading decisions. Wyckoff emphasized the importance of studying price action, volume patterns, and market sentiments to anticipate the future price movements. Okay, so I will just tell you briefly. So Wyckoff method is laid on the foundation of supply and demand dynamics, okay, and the interplay between the supply and demand uh, within the landscape of financial markets, okay. All right. So the Wyckoff actually studied the behavior of price and volume movements, okay, and particularly he studied the relationship between price and volume, okay, and he advocated the idea that if a trader understands the relationship between price and movements and also, okay, understands the relationship between price and volume, okay, then he can make informed trading decisions and he can actually trade like large operators, because when you study the price and volumes relationship, you actually discover the intentions of the large operators like the institutional investors. Okay, so Wyckoff emphasized the importance of studying price action, volume patterns, and market sentiments to anticipate the future price movements. All right. Now, the law of effort versus result. One of the foundational principles of the Wyckoff method is the law of effort versus result. This concept suggests that analyzing the relationship between effort, which is volume, so expended in the market, and the corresponding results, price movement, can provide valuable insights into the underlying supply and demand dynamics. Okay. So in the Wyckoff terms, okay, so one of the foundational principle of the Wyckoff is the law of effort versus result. Okay, the word effort means the volume, and the word result means the price movement. Remember that effort means volume and result means the price movement. So if we study the relationship between price and volume, we can understand the supply and dynamics of the financial markets. Okay. For example, if there is a significant increase in trading volume accompanied by a relatively small price movement, it may indicate that large operators are actively accumulating or distributing shares, setting the stage for potential price reversals or continuation. Okay. So this is a law of effort versus result. Okay. So I'm gonna just explain you further. We're gonna go into a second theory now. Okay. Law of cause versus effect. So law of cause versus effect. So if I want to know about the law of effort versus result, here is the law of effort versus result. Okay. As you can see from here, all right. So here is the volume and here is the price demonstration. So law of effort versus result suggests that the larger the volume or the larger the effort, the larger the price movement or the larger the results. Price movement is equals to result, volume is equal to effort. If the volume is small, then the price movement will also be small. If the volume is huge, then the price movement will also be huge. If the volume is small, then the price movement will also be small. So remember that, okay? And let me show you on the charts here. Now you can see here, you can see that we have a small volume, we have a small volume right over here, and we have a small, let me show you by this way, dot, okay? Now you can see from here, we have a small volume over here, okay? And we have a small price results, okay? The small one, the small price movement. We have a larger volume, we have a larger result, okay? Larger effort, larger result. Larger volume, larger price movement, okay? We have more large volume or more large effort, we have a more larger result. Got it? So this is the supply and demand dynamics. Now let's suppose here, as you see, that we that as the as the as the volume is increasing, okay, the price movement also increases. Just compare these two, okay? Now I'm gonna just suggest you this one. Compare this one, okay? The volume of this one, you can see, all right? So we have a smaller volume and we have a smaller price movement. We have the larger volume, we have the larger price movement. This is known as law of effort versus result. Understand it? I'm gonna show you more on the charts. Here, now if you compare this one, we have the smaller volume, we have the smaller price movement. We have the larger volume, we have the larger price movement. All right. So this is known as the law of effort versus result. Okay, this is what demonstrated by this law of effort versus result. If I want to delve deeper into it, okay, so I can just understand this volume and the price. Then we have to determine the relationship between volume and price. Okay, and I have written over here, so price movement corresponds to the result, volume is effort. So remember that effort means volume, result means price movement. So the larger the volume, or the larger the effort, the larger the price movement or larger the price result. Okay. Similarly, the smaller the effort or volume, the smaller the result or price movement. Got it? It's very simple to understand. This is known as law of effort versus result, principle of Wyckoff method. Now, we're going to delve into law of cause versus effect. The law of cause versus effect suggests that the Wyckoff emphasized the importance of distinguishing between the cause and effect in market analysis. According to this principle, accumulation and distribution phases in the market create a cause that precedes the subsequent effect of a significant price movement. Okay. By identifying accumulation or distribution patterns early on, traders can anticipate the future price trends and position themselves accordingly. This concept underscores the importance of studying price structures and volume patterns to gauge the underlying market sentiment and direction. Okay. All right. So I'm going to show you the law of cause and effect. Yeah. Now you can see that the figure below shows the cause and effect principle of the Wyckoff method. So the Wyckoff method suggests that the smaller the cause, the smaller the effect. Okay. The larger the cause, the larger the effect. Okay. This is only observed in a ranging market. Okay. Or in a sideways market. I have told you previously that there are three types of markets. Number one is the uptrend. Number two is the downtrend. Number three is the ranging market or consolidation. All right. So you can see here that we have a smaller cause here. We have a smaller range here. The range here, let's suppose it's X units. Okay. If the range here, this is a cause. Okay. If the range is smaller, then the price will move, then the move of the price effect will also be smaller. So if we have a X units cause here, then the effect will also be X units. If we have 2X units cause here, then the price will also move 2X. Okay. This is known as the law of effort was the law of cause versus effect. Let me show you on the chart here. All right. For example, I show you two law of effort versus result, right? If I just draw these charts here, okay, if I identify this range here, okay. Now I want to measure this bar here, how long it is, right? Okay. So you can see, all right, from here to here, this is the actual, okay. So you can see that the range is that you can see the size of the range. Okay, this is a range. You can see the size of the range. This is known as cause. Okay. So the larger the cause, the larger the effect. The smaller the cause, the smaller the effect. So you can see here that the price moves here. This is effect. All right. Effect. So this is cause, this is effect. So when we have a larger range, okay, or when we have the larger price range, or when we have the larger cause of the price, okay, development, then we have the larger effect. Okay. Now, let me show you another one. This one. Okay. Now, this is the price range here. All right. So this is the cause. Let's suppose we say it cause one. Okay. And you can see this is the effect. All right. This is effect. Effect one. So as you can see from here, okay, we have this we have the cause one and we have the effect one, and then we have the cause two, okay, and then we have the effect two. We can say that cause two is actually greater than cause one. Okay, the cause two is greater than cause one. Okay, so this is cause one, this is cause two. Now, if we have to see how bigger, how much is the effect one, so we can just measure the height. You can see that the distance is 252 px. Okay, the effect is so we can see that it is 168 px. We will just write down the distance. Okay, the magnitude of the effect and cause for our own understanding. All right. And here, this one is 447 px. Okay. So this is 447 px. Okay, 168 px. So cos 1 is 168 px and cos 2 is 447 px. It means that cos 2 is greater than the cos 1. Now let's go for the effect. Okay. 157 px. Okay. 285 px. Okay, so as we can see from here, when we have a cos of 168 px, okay, then we have the effect of 157 px. Okay, when we have the cos of 447 px, we have the effect of 285 px. This shows that the cos 2 is greater than cos 1, and similarly, the effect 2 is also greater than. So effect 2 is also greater than effect 1. This shows that the larger the range, the larger the price movement out of the range. Okay. The larger and the smaller the range, the smaller the price movement out of the range. Okay. This is known as the principle of cause versus effect. Okay, so it's very simple to remember. When we have a smaller range, then the price movement out of that trading range will be smaller. And when we have the larger range, then the price movement out of that trading range will also be larger. Okay, that's it. Okay, this is what is explained over here. When the range is smaller, the price movement out of the range is also smaller. When the range is larger, then the price movement out of the range is also larger. All right. So this is known as the principle of cause versus effect. Now we have the principle of supply and demand. We have already studied about supply and demand. Okay. All right. So this is a Wyckoff's third law. So the figure below shows supply versus demand principle of Wyckoff. Now this is demand, this is supply. Okay. When the price is increasing, it shows that there is a demand. And when the price is decreasing, this signifies that there is a supply. Okay. So you can see when the demand is greater in length than the supply, the price moves up. Whenever the demand is greater than supply, then the price moves up. When the supply is greater than demand, then price moves down. When demand is equals to supply, then the price moves in a range. Now let me show you on the chart here. Okay, let me remove this all. So here you can see supply is equals to demand. So whenever supply is equals to demand, then the price will be in equilibrium and it will move in range as it is shown here. How about this feature? You can easily see that the price is going up. Okay, let me use the path line. So as you can see, when the demand is greater than supply, the price is moving up. So what is happening here? As you can see here, what happens here? Here in this area, the supply is equals to demand. So the price is moving in a range. Okay, as I can show you in the chart. Okay, here the supply is equals to demand. So the price is moving in range or the price is in equilibrium. Here, the demand is greater than supply. So the price is moving up. So we can say here at this point, demand is okay, demand is greater than supply. All right, demand is greater than supply. So the price is moving up. Here you can see that the supply is greater than demand. So the price is moving down. Okay. Here the here the supply is greater than demand. So the price is moving down. Okay. So whenever the supply is greater than demand, the price moves down. Okay. Whenever the supply is equals to demand, the price moves in equilibrium or in a range. Whenever demand is greater than supply, then the price moves up. Whenever the demand is greater than supply, then the price moves up. And whenever the supply is greater than demand, then the price moves down, as you can see from this situation. Now here again, as you can see that here again, the supply is equals to demand. When supply is equals to demand, this means that the price will move in a range. So whenever the supply is equals to demand, the price will move in a range or the price is in equilibrium. But how about this one? Okay, here the demand is greater than supply. So the price will move in uptrend. The price will move up. All right. Whenever the demand is greater than supply, then the price moves up. How about this one? It's very simple to understand. Here, the supply is greater than demand. Whenever supply is greater than demand, okay, the price will, so whenever the supply is greater than demand, then the price will move down. Okay, this is the law of supply versus demand. So basically, supply means sellers, demand means buyers. Okay. When we say that demand is greater than supply, we say that the buyers are more than the sellers. In this way, whenever the buyers are more than the sellers, then the price gonna go up. Okay. And similarly, we know that the supply is seller and demand is a buyer. So whenever the supply is greater than demand, or when sellers are greater than the buyers, then the price will go down. Okay. And as we know that supply are the sellers, demand are the buyers. So whenever the supply is equals to demand, or when the sellers are equals to buyers, then the price will move in a range or equilibrium. Here the price is moving in a range or equilibrium. Okay. And here the supply is equals to demand. Here in this scenario, okay, the demand is greater than supply, and you can say that the buyers are more than the sellers, so the price is moving up. Here in this situation, the supply is greater than demand, or the sellers are more than the buyers, so the price is moving down. Okay. Here again, you can see that the price is moving in a range. Okay. So we can say that the supply is equals to demand. Okay. Whenever the supply is equals to demand, then the price moves in equilibrium. We say that the sellers are equals to buyers. Okay. So the price is moving in a range or in equilibrium. All right. Here again, what we can see that the demand is greater than supply. The buyers are more than the sellers. So the price is moving up in this situation. Okay. You can see that demand is greater than supply. And we can apply this principle across all markets. Okay. So I hope you got the point of supply and demand. All right. So we have explained, we have understood the entire concept of this one. You can study from this document to consolidate your learning. And I will update this document from time to time so that you can consolidate your learning in a much more effective way. All right. So we are done with this all. And now we're gonna go for the Wyckoff 5-stage cycle. All right. So the Wyckoff 5-stage cycle will be the part of the second video or the second part of this episode. So this is episode number 15, part 1, and episode 15, part 2. We're gonna discuss more about the Wyckoff 5-stage cycles and the model adaptation of Wyckoff. So I hope you have understood everything related to the law of supply versus demand, the law of effort versus result, and the law of cause versus effect. Okay, now we're going to study about the Wyckoff 5-stage cycle in the next video, in the next episode.